Welcome to Countouts. In this lesson, we're going to be looking at deferred tax, and this is IAS 12. Here, we're going to explain important definitions pertaining to deferred tax. We're going to explain what deferred tax assets are, what deferred tax liability is, and we're going to go through some quick examples in explaining these terms, as well as looking at permanent difference and temporary difference, and as I mentioned, with deferred tax asset and deferred tax liability. So what is deferred tax? Deferred tax is the estimated future tax as a result of current and past period transactions in the financial statement. It is an accounting entry and not the actual tax payable to or refundable from the revenue authority. So when you look at the deferred tax amount in the financial statements, or when you calculate the deferred tax amount, this is not the actual amount that you will go and pay to the tax authority, but it's just an amount as a result of the temporary difference between what you have calculated based on accounting standards versus the tax regulations. So if your accounting profits are different from your taxable profits, then you will have deferred tax, provided that the differences are not permanent in nature. And we're going to look at all these and we'll go through an example. So if you do not understand it fully now, I hope you'll understand it as we go along. Deferred tax exists because of the difference between accounting profits and taxable profits. Remember, the profits we consider based on accounting standards from which we calculate the tax expense may not be the same as the profits that the tax regulation will allow. Deferred tax liability is the amount of taxes payable in future periods as a result of taxable temporary differences. And we're going to go through a detailed example and explain a deferred tax liability. Now, a deferred tax liability is a non-current liability. It's not a current liability, so you must be able to distinguish between tax payable and deferred tax liability. Tax payable or income tax payable is a current liability, while deferred tax liability is a non-current liability. Deferred tax assets, on the other hand, is the amount of income taxes recoverable in future periods as a result of deductible temporary differences, unused tax losses carried forward, and unused tax credits carried forward. Now, this will make sense, obviously, with the help of examples, as many people struggle with the definition of how deferred tax works unless we go through an example. Well, here are other important definitions that we have to look at before we look at the examples. Accounting profit or loss is profit or loss for a period in accordance with accounting standards before the deduction of tax expense. Very important to note. Accounting profit is not the same as taxable profit. Accounting profit is based on the accounting standards, while taxable profit or loss is the profit or loss for a period determined in accordance with the rules established by the revenue authority upon which income taxes are payable or recoverable. Now you can see the difference between the two. The rules which are followed in getting to this point is what determines whether it's an accounting profit or a taxable profit. Accounting profit is based on accounting standards. Taxable profit is based on the rules established by the revenue authority. So let me mention this. If your accounting profit is the same as your taxable profit, you have no deferred tax for that period. But if they are not the same, that means that we have to reconcile them. And that is where deferred tax come into the picture. And the reason they may not be the same is because maybe we have recognized an income based on our accounting standards, but according to the tax rules, it says you can't recognize that as an income. They don't allow it. Or maybe we have omitted an income because we have not earned it yet, while the tax authority says, no, since you have received the money, you have to recognize it as an income. And that is why they would be different. And we'll see now as we go through the examples. Another definition here is the tax expense or the tax income, which is the aggregate amount shown in the statement of comprehensive income as income tax expense or income. This includes both current tax and deferred tax. Remember, in your income statement, when you're doing the reconciliation, not only do you have the current tax that you're paying over or that you owe the revenue authority, but you also include the movement in deferred tax. Now, we'll look at these examples when we go through this topic in this lesson and in the lessons that are to follow. You'll find them in the description below once they're loaded. Current tax is the amount of income tax payable or recoverable in respect of the taxable profit or loss for the period. This is determined in accordance with the rules established by the Revenue Authority. So how do we get the current tax? Well, we take taxable profit and we multiply that by the tax rate that the Revenue Authority has set up. So that is where we get our current tax. But tax expense, as you can see here, as I explained before, it includes the current tax, which is what we have just explained down here, and the movement in deferred taxes I just mentioned. So the current tax is the tax that we owe to the Revenue Authority, or that is recoverable from the Revenue Authority based on this period. Now, what are permanent differences? Let's first look at permanent differences, which are very easy to deal with. In fact, when you have permanent differences, then you don't have deferred tax. These are one-off differences between accounting profits and taxable profits as a result of expenses or income that are not allowed or taxable according to tax regulations. These items will never reverse in subsequent periods. And that is why it's a once-off difference, because it will never reverse in the periods to come. You can't say that, okay, it's a difference that we have in this period, but we're going to recover it in the next period, or it's going to be payable in the next period. No, that is where you have temporary difference, which we are going to just now. But when you have permanent differences, these are differences which are once-off. Meaning, if my accounting profit is different from my taxable profit because of a permanent difference, then we don't have deferred tax. We just have to reconcile the two and see why they are different, and we deal with that. And here are very popular examples. They are the main examples why you have permanent differences. The examples here are traffic fines and local dividend income. What do I mean by this? Well, a traffic fine is an expense. Because we are paying for traffic fines, we consider it an expense, and it will go into our income statement as an expense. But according to the Revenue Authority, or according to tax regulations, they will say, no, we do not allow the tax expense as a deduction. Meaning, according to the tax regulation, you can't use that to deduct or to reduce your amount of taxes. Remember, expenses reduce the amount of taxes we pay. Another one is a local dividend income. If you get a local dividend income, you will recognize it in your statement of comprehensive income or in your income statement. But according to the Revenue Authority or the tax regulation, they will say that we do not include this, or we do not recognize this as an income. That means if they don't recognize an income, it's good for you, because for every income you have to pay taxes on those. But if they say we're not going to include the dividend income, then you will not have to pay tax for that particular income. So these are once-off differences. And why are they? Well, because if I've included traffic fines, for instance, as part of my expenses to arrive at my accounting profits, and according to tax regulations, you're not allowed to include it, then our taxable profits will be more, because we'll remove these traffic fines as an expense. You can't say you have a deferred tax, because it will not be recoverable in the future, or it will not be incurred in the future. These traffic fines will not be incurred in the future. You can't say next year tax regulation will consider it as an expense. It won't. If it doesn't allow it, it does not allow it. And that's why it's a once-off difference. Now let's go through a quick example in explaining permanent differences here. Here's the first example. We're told that Rainshine has a profit before tax of 25,000 Rand. Included in the profit are traffic fines paid of 2,000 Rand and local dividend income of 3,500 Rand. The tax rate is 28%. Calculate the current tax expense and deferred tax expense for the year. Now, if you have to calculate your current tax expense and your deferred tax expense, we have to take everything that we are given into account. We have said, or we have been told, that the profit before tax is 25,000 Rand. And we're told that this includes traffic fines and local dividend income. And that means that this profit before tax has been calculated based on accounting standards. So this profit before tax is my accounting profit. Now I have to change it into taxable profit, or I have to reconcile it to make it a taxable profit so that I know how much taxes I will be paying. Now let's start. The first one here we have is profit before tax. We were given 25,000 Rand. And now what we'll have here is the exempt differences, meaning differences that are exempt based on tax regulations. And the first one we have there is the local dividend income that we are given. The local dividend income, we recognized it as an income to arrive at the profit before tax, but according to tax regulation, we are not allowed to include the dividend income, the local dividend income. It is not allowed. That means we have to deduct it from the profit before tax. Remember, local dividend income is an income, and we included it as a positive. Now we have to remove it, so we minus it. So you put dividend income and you put it as a negative. okay, to remove it from the 25,000 rand. The next thing that you have to do there is the traffic fines. The traffic fines are expenses. That means we deducted it before we got to profit before tax. Now we have to add it back because it's not allowed as an expense by the revenue authority. So we have to add it back. So we put it as a positive. So remember, any income that is not allowed, you have to put it as a negative, or you deduct it because you had added it. And any expenses that are not allowed, you have to add it back. So you put it as a positive. So we put the traffic fines and we put the 2,000 rand. Now what do we have to do? We have to get now to taxable profits. Now we can do that. We take 25,000 rand minus the 3,500 rand plus 2,000 rand, and we get an amount of 23,500 rand. That is the profit after exempt differences. Now, if you have any other temporary differences, that's when we put them down here. But since we have no temporary difference, we are not told anything else. The only thing we had was traffic fines and local dividend income. We have no temporary differences, so we put it as a negative. And what do we get to? We get to what is called taxable profits. That means according to the tax regulations, the profits that will be subject to tax is the 23,500 rand. Now we can calculate the current tax based on the taxable profits. Remember, the current tax is the tax that we have incurred during this period. So we put there the current tax expense, which is at 23,500 rand times 28%, because that 28% is the tax rate we were given, and get an amount of 6,580 rand. Now again, we don't have any temporary differences. That means that we have no deferred tax. Remember, for permanent differences, we have no deferred tax. So we have here deferred tax expense, which is nothing, which is nil. And then we arrive at our total tax expense, which is the 6,580 rand. Remember, our total tax expense is going to be our current tax expense plus our deferred tax expense. And how do we get our deferred tax expense? Well, it's the movement in deferred tax that we put here. And that is it. Our total tax expense is 6,580 rand. I hope it has made sense with the permanent differences. When you have permanent differences, you don't have deferred tax. Now let's move to temporary differences, where many do not like to go. So what is the temporary differences? Well, these are differences that occur as a result of the difference between the carrying amount of an asset or liability in the statement of financial position and its tax base. Very important. Remember, this is not just the carrying amount of an asset or liability. It could be an income and expenses, and we'll go into that in the lesson that is to follow. And you can check the link below to see that one here, where you have things like accruals that are recognized differently. You'd have your temporary differences here. The main temporary difference that is usually dealt with is with an asset or liability in the statement of financial position versus their tax base. And what is the tax base? The tax base of an asset or liability is the amount attributable to that asset or liability for tax purposes. This is calculated based on the application of tax rules. So what do we mean by tax base? Well, I'm sure if you're doing deferred tax, you are at the level where you know how depreciation works, you know what the carrying value is, and you know how to do their calculations. So the carrying amount, obviously, you know, is your cost minus your accumulated depreciation. And that is based on our accounting policies or on company policies. But the tax base of an asset, for instance, if you're dealing with the machinery, we have our accounting policies on how we depreciate it. But according to the tax regulation, they also have their rules on how assets should be depreciated. So for machinery, for example, the tax authority will tell you that we recognize the depreciation rate to be 40% or 50%, for instance. If it's different from your percentage, then you will have what is called temporary differences. Why is that? Because depreciation is an expense. Depreciation is recognized as an expense in the income statement, but depreciation, according to our accounting rules or according to our company rules, may be different from the depreciation recognized by the revenue authority or by the tax rules. So that is what the tax base is. According to the tax rules, what is the value of this machinery, or what is the value of this asset, or what is the value of this liability? And that will affect our depreciation amount, which in turn affects our taxable profits and our accounting profits. If your tax base and your carrying amount is different, that means you will have a deferred tax, or you'll have a temporary difference. Carrying amount based on our accounting rules or our company rules, tax base is what the revenue authority recognizes as a cost of that particular asset or liability. Now, what are temporary differences? Well, temporary differences may be one of the following two. It can be a taxable temporary difference where you have what is called a deferred tax liability. And remember, like I mentioned earlier on, look at the definition of a deferred tax liability. It's a non-current liability. Or you have what is called a deductible temporary difference, which results in a deferred tax asset, which is a non-current asset. I hope it's making sense so far. A temporary difference can either be a taxable temporary difference, meaning that the amount is going to be taxable in the future, or it can be a deductible temporary difference, meaning that the amount will be subject to a deduction in our tax, and that is where you have your deferred tax asset. So let's first look at taxable temporary differences. What are taxable temporary differences? Well, these are temporary differences that will result in taxable amounts in determining taxable profit or tax loss of future periods when the carrying amount of the asset or liability is recovered or settled. And when will this occur? Well, you'll understand it better when you look at this. This will occur when the carrying amount of an asset is greater than the asset's tax base. Remember, we're talking about the carrying amount and tax base. Carrying amount based on our rules, tax base based on tax rules. So, if we are dealing with the machinery, for instance, if the carrying amount of the machinery is 50,000 Rand, according to our rules, and the carrying amount of that machinery is 30,000 Rand according to the tax rules. That means your carrying amount is greater than your tax base, and that's where you'll have a deferred tax liability. It also occurs when the carrying amount of a liability is less than the liability's tax base. Okay, but the most likely one that you'll always be dealing with is the asset and not the liability. So the most popular one and the most popular questions comes from the asset. And we'll look at an example just now. And what is the journal entry when you have a taxable temporary difference? And that is why you have a deferred tax liability. Well, you're going to debit your deferred tax expense, which will appear in your statement of profit or loss or in your income statement. And then you're going to credit your deferred tax liability, which goes into your statement of financial position, and it's a non-current liability, as I mentioned. And obviously the narration there is provision made for deferred tax expense. What about deductible temporary differences? What about them? Well, deductible temporary difference, as we mentioned, will lead to a deferred tax asset, which is a non-current asset. And these are temporary differences that will result in deductible amounts in determining taxable profit or tax loss of future periods when the carrying amount of the asset or liability is recovered or settled. Very important that we note that it's future periods. What we are saying here is that in the future, you will have an amount that will be deductible when we are determining our taxable profit or our tax loss of future periods. And when will this occur? Well, this occurs when the carrying amount of an asset is less than the asset's tax base. So if the carrying amount of your asset is less than your asset's tax base, then you know that you have a deferred tax asset or deductible temporary difference. Also happens when your carrying amount of a liability is greater than the liability's tax base. So if according to your books or according to your rules, the liability is greater than according to the tax rules, then you have a deferred tax asset. Or if the carrying amount of your asset is less than the tax base of the asset, meaning the value of the asset according to the revenue authority, then you know that you have a deferred tax asset. Now we're going to go through examples where you'll hopefully get to understand this well. And what is the journal entry when you have a deferred tax asset? Well, it should be just as easy. You debit your deferred tax asset, and that is the one in the statement of financial position as a non-current asset, and you credit your deferred tax expense, the one that will go into your statement of comprehensive income or in your income statement or profit or loss. And the narration there is still the same as a deferred tax liability, provision made for deferred tax expense. Now let's go through an example quickly in applying what we have just been looking at. Here we are told that on the 1st of January 2020, a machine with a cost of 20,000 Rand was purchased. According to the company policy, machinery is depreciated at 20% per annum using the straight line method. I'm sure you should know that. The tax allowance for machinery is 50% according to the tax authority, meaning that the machinery is depreciated at 50% based on the tax rules. The tax rate is 28%. Calculate the deferred tax expense and journalize the entry. We have to calculate the deferred tax expense and journalize the entry. Now, I can tell you it's going to be very easy for us to do this. I mean, this is as basic as it can get. So follow along well and try and understand it. First thing that you see there is, according to the company policy, the machinery is depreciated at 20% per annum using the straight line method. But according to the tax allowance, the machinery is depreciated at 50%. And the tax rate is 28%. So when we're calculating our deferred tax expense, here's what we'll do. The first thing that we'll have to do is to determine, according to our tax rules, what is the value of the asset. According to our own rules, or the carrying amount of the asset, what is its amount and what is the temporary differences that we have therein. So here's how we'll do it. We open this table, and you don't have to use a table, by the way. It just gets easier. You don't even have to draw any table, but it's usually tabulated this way to make it very easy for you to be able to do it. But you can even do it in your calculator and you should be able to get your answer. Now, what is the cost of the asset? Well, the cost of the asset according to our books is 20,000 Rand, and the tax base is also 20,000 Rand. So there's no temporary differences on the cost of the asset. Now we calculate our depreciation of the asset. What is the depreciation of the tax allowance? Well, the depreciation based on our books is 20% per annum using the straight line method. So what are we going to do? We're going to take the 20,000 Rand times 20% and we'll have our depreciation for the first year. So the 20,000 Rand times 20% will give us 4,000 Rand as the depreciation based on our accounting rules. Remember that? And then based on the tax authority, what is it? Well, the tax allowance for the machinery is 50% according to the tax authority. So we're going to take the 20,000 Rand times 50% and to give us our tax allowance or the depreciation based on the tax rules. And now, do we have a difference? Yes, we do, because the depreciation based on our books or the carrying value is 4,000 Rand, while based on the tax rules is the 10,000 Rand. So we have a difference there. And what is the difference? The difference is 6,000 Rand. We took the 10,000 Rand minus the 4,000 Rand. So we already have a temporary difference. So we know already it's going to be deferred tax. And then what is the carrying value of the asset at the end of the period? Well, we'll have the 20,000 Rand minus the 4,000 Rand to get the carrying value, and it's 16,000 Rand. And the tax base is going to be the 20,000 Rand minus 10,000 Rand is going to give us 10,000 Rand. And what is our temporary differences there? Well, it's the 16,000 minus the 10,000, and it will also give us the 6,000 Rand. Easy enough so far. Now we have to determine whether you have a deferred tax asset or a deferred tax liability, because we're asked to journalize the entry as well. What is it going to be? Well, let's bring back our theory that we've been going through. When is it the deferred tax liability? If the carrying amount of the asset is greater than the asset's tax base, then you have a deferred tax liability. And remember, we're dealing with an asset here, so we're not even going to look at the liability. And then it's a deferred tax asset if the carrying amount of the asset is less than the asset's tax base. Well, you can see here the carrying amount versus the tax base. So we have here a deferred tax liability. So I hope it was easy enough for you to be able to identify that based on the information that we've been going through. So here's a tip for you. If your depreciation percentage is less than your tax percentage, then you will always have a deferred tax liability. So you can see here, our depreciation is 20%, while the tax allowance is 50%. So the tax allowance is greater than our depreciation percentage. That means that we have a deferred tax liability. So you don't even have to do this calculation to know you have a deferred tax liability. You can identify it based on the information you're given in the question. So if your depreciation percentage is less than your tax allowance, then you will always have a deferred tax liability. And then what is the journal entry that you're going to pass here? Well, the first thing that we have to calculate here is the deferred tax liability. Since we know it's a deferred tax liability, let's calculate it. We're going to take the temporary difference of 6,000 Rand and we're going to multiply that by 28%. And it's going to give us an amount of 1,680 Rand. And that is going to be our deferred tax liability. So what is our journal entry for this? Well, the journal entry is going to be debiting our deferred tax expense, that is in the profit or loss, and then we credit our deferred tax liability that will go into the statement of financial position as a non-current liability. And we put in the amount there, 1,680, and then the narration there is provision made for deferred tax expense. But Let's use logic here. Why is it a deferred tax liability? Well, because our accounting profits based on this information is higher than taxable profits. And why is that the case? Well, because our depreciation amount is less than the tax allowance. So if our depreciation amount is smaller, that means we expect to pay more taxes because depreciation is an expense. The smaller the expenses that we have, the higher the taxation that we are paying. So our depreciation is less than the tax allowance. The tax allowance is 10,000 rand, while our depreciation is only 4,000 rand. So according to our books, we ought to be paying more taxes. But according to the tax authority, we owe less taxes because they gave us a higher depreciation or a higher tax allowances. That means we can have a bigger deduction as an expense, which is the 10,000 rand. That is why we'll actually pay less taxes than what we would pay based on our accounting rules. But we know that in the future, it's going to catch up to us. And we will see that in our future lessons as we'll be looking at that, where we'll look at 1 year after the next, what's going to happen over a period of years with deferred tax when you're dealing with things like depreciation. And that is the logic behind it if you think of it in those terms. I hope it has made sense in identifying what the deferred tax liability is. Now, let's switch this question around and try and see how it would work if we have a deferred tax asset based on the information that we are given. So here we have the same exact question. On 1st of January 2020, a machine with the cost of 20,000 rand was purchased, but according to the company policy, machinery is depreciated at 50% per annum using the straight line method. The tax allowance for machinery is 20% according to the tax authority. The tax rate is 28%. Now, can you see the difference between this question and the previous one? The only difference here is that we switched the percentages around. Now, what I would want you to do here is to gauge your understanding on this example here. Pause the video here and try and attempt to answer it. We are asked to calculate the deferred tax expense and journalize the entry. So pause the video, attempt it, and then continue, and you can compare your answer to mine. Okay, I hope you have attempted the question. So let's go ahead and do it here. Well, the cost for the carrying amount and the tax base is the same as the 20,000 rand. There's no temporary difference for the cost. But when we're calculating our depreciation, it's going to be 10,000 rand because according to our rules or according to our books, the depreciation rate is 50%. So we're going to take the 20,000 times 50% and it gives us a depreciation of 10,000 rand. But based on the tax rules, the tax allowance is 20%. So we're going to take 20,000 rand times 20% gives us 4,000 rand, and that is the tax allowance. And the difference here is 6,000 rand, which we get by taking the 10,000 rand minus the 4,000 rand. So our carrying amount or our carrying value is 10,000 rand based on our books, but based on the tax rules, it's 16,000 rand. So there's a temporary difference of 6,000 rand. So again, here, do you have a deferred tax asset or a deferred tax liability? Well, I hope you attempted the question, but I hope you are also able to identify whether it's a deferred tax asset or a deferred tax liability. How do you do that? Well, you can see here that our depreciation percentage is higher than our tax allowance or the percentage according to tax rules. Our depreciation is 50%, while the tax allowance is only 20%. That means we have a deferred tax asset. Remember, if our depreciation percentage is higher than our tax allowance, then we have a deferred tax asset. I hope you're able to now identify it that way. But if we bring back our theory, you can see here, if the carrying amount of an asset is greater than the asset's tax base, then you have a deferred tax liability, which is not the case in this example. Based on our books, the carrying amount of the asset is less than the tax base. That means that if the carrying amount of the asset is less than the asset's tax base, then we have a deferred tax asset. So you can see that we've identified that one easily. So that's the deferred tax asset. Now let's calculate the deferred tax expense. Well, it's still 6,000 rand. So we're going to take the 6,000 rand times 28%. It gives us 1,680. So once we have the amount, let's journalize the entry. We're going to debit the deferred tax asset that goes into your statement of financial position, obviously, as a non-current asset, and we credit our deferred tax, and that goes into your statement of profit or loss or the statement of comprehensive income, and we have the amount here. And obviously the narration is provision made for deferred tax expense. Now, if you have no prior year's deferred tax, then this obviously will go into your income statement as deferred tax. But if you have deferred tax from prior years, you'll see whether it has increased or it has decreased, and the difference will go into your income statement. And we'll look at that in our future lessons, like I mentioned, and find them in the links in the description below once we put it there. I hope it has made sense. I hope the lesson was thorough enough and you're now able to do your basic deferred tax question. If you want more advanced, we'll look at it in our lessons in the links in the description below. If you have gained value from this lesson, please subscribe to our channel, like this video, and share it to those who think it might help. And if you'd like one-on-one sessions with us, we offer them at the reasonable rates, and you'll find our contact information in the description below. Till next time, cheers.